Hey, welcome, welcome. Let's see if we've got our sound working. Let me know if you can hear me. I'm going to get right into this, and if for some reason you see my lips moving but you can't hear me, let me know in the comments and I'll get that fixed. Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm here to help you maximize your cash flow. So, this is our live stream. Welcome. This is Wealthcare Wednesday, where we're going to spend a few time. Oh, all right, good, good. You can hear me. We're going to spend some time and take a little bit of time out of our week, and we're going to address our cash flow. If you guys have questions, put them in the comments section, and I will do my best. Okay, great. I will do my best to answer your questions. I have a few questions that came in via the voicemail, which is awesome. I'm going to be sharing those with you guys and answering those. I wonder if my sound is matching my voice. I know last week we were a little bit off, so I tried something a little bit differently. We'll see if that works. But I will be answering voicemail questions. Remember, if you have a question that you would like to leave a voicemail and I can play it on here rather than typing in a question in the chat, go to my website, www.oregoncashflowpro.com. At the top, I have a blog post pinned that is for leaving voicemail messages. You go into that and there's a record button, list of ideas, things that you might be able to choose from to come up with some questions if you're struggling. Get that creativity flowing. Click the record button. You got 2 minutes. You can leave a message. Really, I'll answer questions on any topic that you'd like. I may or may not know all the answers, though. I definitely do not know everything, but we have a good group of folks here watching that I'm sure will be glad to chime in if you ask a question I don't know and they do. So feel free to leave a voicemail message. It won't get on today's live stream, but we do this every Wednesday at 6 p.m. So you can get on next week's live stream if you get in basically anytime between now and next Tuesday, and I will try and get all those questions. Now, if we get too many questions, obviously we'll break it up, but my goal is to answer your questions in a timely fashion so that you can take advantage of the information that we're sharing and learning here today. So, all right, we've got a good group of folks here on the line. I recognize some of you. Some of you I talked to this week, and some of you I've got an appointment to talk to soon. So I'm not going to say anything that I think most of you guys don't already know, but there is an ability to sign up. You get a 20-minute free chat with me, free consultation. We can talk about anything that you'd like. Obviously, my goal is to help you maximize your cash flow. We do that through dynamic banking and infinite banking. And to sign up for that chat, you go to calendly.com/cashflowpro. And I'm going to put that in the comments section so you guys can have that link and it's easy to get to. But if you would like to sign up and talk about any of those things, if you want to talk about an insurance policy, if you want to talk about getting one, or if you want to talk about one that you already have and you just want a second opinion on it, or you want to figure out a better way that you can utilize it, talk with me. You don't have to pay. There is paid options, but for the most part, everybody gets at least one freebie. You just click on and sign up for the 20-minute option. If you're up for it and you want to compensate me for my time, I would appreciate that. I'm certainly not going to turn it away. There is a $30 paid option for 30 minutes of my time. Now, inevitably, we're going to go over, if it's the first time you and I have talked, I don't charge you anything extra for that. If it's the free one, I don't charge you for it. If we go over, I expect you'll have a lot of questions. I try and give you what I can. And you guys have been keeping me pretty busy, I got to say. So I really appreciate it, though, because I have a lot of fun doing this. So let me get that website address typed in, and then we will jump in to the questions. All right, there's the link in the chat. And what we're going to do today, I always want to try and give away some prizes. So we'll give away at least one t-shirt or one book. We'll see what you guys want to have. So if you leave a comment, say what you would like to win for a prize in today's video. I know some of you guys already won prizes the last couple of weeks. So feel free to shout out for a different prize. And then what I think I'm going to do when we do the prize drawings is we will have everybody on the chat just pick a number between 1 and 10. I'll go to my random number generator. Whatever one that matches will be the winner. If it's a tie, if a couple of you pick the same number, no problem. We'll narrow it down. I will run the number generator again, and if there was 3 people, and I'll do a number generator between 1 and 3. If a 2 pops up, the second person that claimed that number will be the winner. Sounds simple enough? I think it'll work out. If you guys end up with other ideas, let me know in the comments section. But that's what we're going to go with as of now. So let's get into the viewer questions. Since you guys have kept me so busy, I couldn't do a whole lot for generating some background graphics. But I did get the questions coming up. And I don't know if you guys noticed, but we do seem to have a struggle with the live subscriber count and the recent subscriber count updating. It seems like Leonard's been the recent subscriber for a long time, but our subscriber count has kept on climbing. So at least we're doing good there. One of these days I'll figure out how to make that work. All right, viewer question number 1 coming up. This is from our own Poker Paparazzi. Let's see what he's got to say.
Hey James, this is Leonard, aka the Poker Paparazzi, and I had a couple of questions that I wanted to run by you. I'm gonna go ahead and break these up into segments. So the first question I have is I've been hearing about a product that's being sold by another life insurance agent. It's called the MPI, or Maximum Premium Index, so some sort of fund, and I believe it's built on a index universal life policy. So I was wondering what makes this type of policy special. And I was wondering if you had any programs that were similar to an MPI. Thanks.
All right, good question. So some of you may or may not be familiar. This guy's on YouTube quite a bit. MPI. I think his name is Curtis. I'm a bit familiar with him and with his program. I've seen one of his presentations. One of our viewers at a previous live stream shared it with me afterwards, so that was great. He utilizes an IUL, and from what I gather from it, he's got a marketing. His marketing on it is all about how they're going to provide some type of a match so that you can increase the amount of premium that you're going to end up paying each year. And in the presentation that I read, it made it sound like it was something that was exclusive to MPI, that MPI was going to be providing that match. There isn't a whole lot of details in the presentation. There's a lot of numbers. There's a lot of promises as far as what you can earn and the type of interest rate that you can get on it, type of growth you can expect from it. My impression of it was it's a bit rosy, and I talked to him on his channel about this. He doesn't talk much about the downsides of the IULs, and that's what he's basing this whole plan on that he's presenting. So that's one of the issues I had with it. And then when I came to the match portion of it, I was like, oh, this is intriguing. You're going to do a match. And if you dig into it, it looks like right at the end of it, it reveals what it actually is. And what it is is something similar to what we talk about doing here, which is we just use the cash value that we generate in our policies in order to borrow against it and then put money back into your policy so that you get up to the MEC limit. Now, on my videos, I talked about using a line of credit to do that, where we start with the line of credit and then we pull from the policy and put money back in and pull and put it back in until we hit our MEC limit for each year. His is similar to that, except it doesn't use a line of credit, and it starts with your cash at the beginning of it. They make it sound like they're matching it, but they're not matching it. Really what it is it's just you using the cash value from your policy. This was my understanding. So if some of you guys, if any one of you have actually worked with him and this is different, let me know. If you find out that this is correct, let us know. It'd be good to know either way, because obviously I'm not going to be buying a policy from him. But that's my impression of it. So they've got the match, which is essentially the same thing that I've been pitching. So on the face of it, I'm okay with what they're presenting as far as a product. The qualms that I have about it are just, I think he's being a little unrealistic in their presentation. And so I hesitate. How do I want to put this? I hesitate to wonder, or I'm concerned about his clients and where they'll be, 10 years, 20 years down the road when that policy doesn't actually perform as he's basically convincing them that it will perform at. So when I talked to him, I said on his channel, when I was addressing what I had seen, I said, look, you're being really rosy. All of your projections are like best case scenario, but you're presenting them as if it's a conservative guess, as if a 7% compounding growth is a conservative growth rate to project. And I don't view that, I don't think that that's a conservative. I think that's kind of at the high end. Most IUL carriers right now are limiting what you can illustrate to somewhere between 5 and 7%. So like 7% is at the top end of what we're seeing. Now that's before bonuses, of course. After bonuses, so depending on which carrier you're using, after bonuses you can certainly get above 7% based on the illustrations. But if any of you are agents out there, an illustration, or if you've owned one of these, an illustration is only good on the day that it's printed. They have to make assumptions about moving forward. How are we going to project these policies to perform? And when it comes to a whole life policy, those projections are based on the dividend rate that the companies are currently earning, because that's how we get above the guarantees that come with those policies. When it comes to IULs, the projection is on, we're going to look back at the historical performance of the indexes that you're tying to, and we're going to project those out going forward. Now, the industry has done a much better job lately of regulating what gets illustrated. It used to not be controlled, and the numbers that were being illustrated were just crazy high, and people weren't actually seeing that performance. Now, cap rates used to be higher than they are today. So some people had some good years and there was some really good performance. You could see maybe 11 or 12 or 16% growth that was happening back when we had that nice bull run of the stock market. We're in a different environment now. This is the first year, obviously, we hit a recession and numbers tanked for a lot of people. So different environment. And what did we see happen from the insurance companies? When the volatility kicked in, they all reduced their cap rates. And this was something that Curtis at MPI did not address. He doesn't even account for it. I said, when I had talked to him, I said, you've got to assume, or you at least have to acknowledge that there's a risk here that when we get into a volatile stock situation, these insurance companies can reduce these cap rates. And the contracts that we get into with IULs allow them to reduce those cap rates really, really low, as down to 3 to 5% for a cap rate, which is extremely low. And if they reduce their cap rates down to 3 to 5%, you are not going to get a 7% average. You're not going to get a 10% average. You're probably not even going to get that 5% average if 5% is the cap rate. So that's my concern. I want you guys to know what you're getting into. If I am a fan of the IUL products, but we've got to be realistic. When I do an illustration, I dial it back a bit. I'd like to dial it back to a 6% growth rate. And that way, 10 years down the road, 20 years down the road, if you're at 6%, you've got what you expected. If you're above that, you're thrilled. If you're below that, shouldn't be hopefully too much below that. But it's a big difference because, man, when you start increasing those interest rates in the projections, the numbers just skyrocket. And they're very, very attractive. So I understand why people are drawn to these products. I'm drawn to these products for the same reason. Growth potential. But you got to remember, that's just the potential. It's not guaranteed. So let's see what Top Gun has to say here. So we need to get a solid IUL and then get a cash value life insurance line of credit. Yep. Interest rates are super low. The best thing about what MPI offers is convenience. I think it comes at a loss of flexibility. Tell me more about what you mean about convenience and what you see as loss of flexibility, because my understanding is that they work with Mutual of Omaha, which I'm contracted with them, but I haven't written any IULs from them. So I need to get on there and see what I can play around with. But IULs in general tend to be very flexible. So I'm not sure what the loss of flexibility is that you're referring to. And I'd like to hear more about that. So let's see. Thanks for the MPI feedback. Just to follow up, is there an alternative you'd recommend? Or better question, how would you structure market an MPI equivalent? Oh, good question. So, yes. There is an equivalent, at least as far as the products that I'm aware of. So I like the Allianz product when it comes to potential cash growth. They have an awesome bonus option that's available. They have that charges you a 1% asset fee. They also have a good bonus option that is free. Both of those bonus options really give you the potential to jack up the growth in your policy. So I really like Allianz for that. When it comes to, and this will come up in one of the later questions, but when it comes to the top companies that I like to work with, National Life and Allianz are the top two as far as the IUL goes. And Allianz, the reason they're in that top two is because of their potential growth opportunity as well as the guarantees that come along with that. Their bonus options have some guarantees that you just don't see with a lot of other companies. And then the asset charge also is lower than the asset charge that you see from other companies that attempt to offer some really high bonuses. So that's where I put Allianz at. And when it comes to putting money in, borrowing from your policy in order to get back up to your MEC by putting more back in, we can do that with any IUL. So it's not anything special that MPI offers. Their marketing says that it's a unique thing that they do, and it's really not. It may be unique in how they present it to people. So if you're not aware, and if that's the only people you've been talking to, it's easy to buy into that. So Top Gun, I've been trying to shop around for the best rates. You've seen under 3%. He uses 4%. I've seen HELOCs as low as 2%. Okay, he uses 4%. I didn't see that in the presentation. I thought, oh, maybe that's what Mutual's rate is. And I might have just skipped over that. So yeah, Allianz has a 5% fixed rate that's out there. So it's possible that Mutual of Omaha, if that's what he's using, that they offer a lower variable interest rate Maybe it's a fixed interest rate. Let me know if you know the answer to that. They just match with your gains and automatically reinvest the gains. Yeah, they don't really match it though. From what I read, it didn't look like they were matching it. What it was they were just showing you how to match by pulling out your cash value and putting it back in. You can't shop around for the best interest rate on a cash value life insurance line of credit. Um, Maybe. I know that there's some banks that will do a line of credit. I know I'm working with at least one person in Illinois who works for a bank. He's a bank executive, and he's planning on one of the guys in his office is planning on setting him up because he doesn't set up the lines of credit, but somebody else in his office does. He's planning on getting a line of credit from the bank for, I think it was 2%, somewhere right around 2%, that they're willing to do a line of credit against the cash value in his policy. So it is an option out there. It might be tough to find. So if you would like some more information on that, or if maybe you want a heads up, I can try and ask him, see what bank. I think it's U.S. Bank is who he works for. So let's see. That's what you mean about convenience versus flexibility. Oh, the flexibility and means you can't shop around for the special match that they're trying to offer. Oh, let's see. No, sir. I was referring to your question about the drawbacks of MPI versus doing it yourself. Okay. Yeah, I'm still a little bit confused, but I think we've got quite a bit of information out there that maybe we won't actually get to the answers without digging into it. Okay, I was correct on something there. All right, I appreciate you weighing in there because you were the one that Top Gun because you were the one that sent me that presentation from MPI, and I appreciate that. It really gives me some good insight into what some other people are doing. Yeah, a little bit of a lag. I haven't figured out how to solve that yet. One of these days, maybe I'll get somebody to help me do these presentations, and we can figure out how to run it a little more smoothly. Okay, moving on. I am going to bring up our next question. Otherwise, we won't get through these things. Next question coming up.
Hey, James. I am curious about setting up multiple life insurance policies, whether they're whole life or index universal. And I was wondering if there were benefits to staggering the policies and or, kind of like divvying them up over a number of years. Any thoughts or any suggestions on when might be an appropriate time to set up the policies? Thanks.
All right, good question. That was Poker. I don't know if you recognize the voice, but he had a couple of questions, so I've got him in line as he asked them. So the question is about staggering whole life policies. I am a fan of staggering the policies. I'm a fan of having multiple policies. I think it provides a greater flexibility for the client. With my policies, I tend to stagger them because I have different income that comes in at different times of the year. That does a few different things for me. One, I can concentrate on having the premium available for the next policy that's coming up in line. I don't have to worry about multiple policies popping up at the same time and having to come up with a larger amount of premium all at once. It also gives me the flexibility to pull cash value from one and pay the premium on another if that's the way I need to do it. Because we keep, when we're practicing infinite banking, we are trying our best to keep all of our income inside our life insurance policy. Or if we're practicing dynamic banking, we're trying our best to always be offsetting interest. So if I don't have cash that's just sitting around to pay premiums, I'm either using it to offset interest or I'm using it to get growth out of it by sitting in my insurance policy. So one way or the other, that money is being used for a purpose, and it's a lot easier if I can focus on whatever policy is coming up. I'll fund that one, and then I'll look and assess where's the best use of the cash value that I have right now. Oh, you got your sweatshirt. That was fast. If you're up for it, email me a picture. I would love to see it. And if you're okay with me sharing it, I would love to share it on our Facebook group too, so people can see it being modeled. I have not seen the sweatshirt yet because I didn't order a sweatshirt. I just have one of the t-shirts. So that's awesome. And that was fast. So back when I got my t-shirts and stuff ordered, it took like 3 months because it was right at the beginning of the pandemic. And so shipping was just really, really delayed. And yeah, it was a nightmare. Benjamin says, for IULs, is it better to pay monthly or yearly? It depends on what is best for your budget. You're going to, with IULs, it's a little bit different. It's a little bit different than whole life policies. With whole life policies, it's cheaper, it's less expensive if you pay yearly, because whole life policies assume that when you do a monthly premium, they assume that you paid it all at the beginning of the year or all at the beginning of your policy anniversary, and they're going to credit you the dividend rate for the whole year based on that. So when they stretch your payment out over the month or over month to month for the whole year, they increase it slightly to account for that dividend that you didn't actually have the money in, but they're crediting for you. So they're going to add a little bit to that. And then also it's just like any other company, like your insurance company. If you break up your payments over the year, they tack on a little bit extra just for doing that. So with whole life policies, you're slightly better off, depends on how big your premium is and what they're breaking up on that. The way I design it with Guardian, it's just based on the base premium, so it's a very small amount. Doesn't make a very big difference overall in the life of the policy. And year to year, I mean, you're talking a pretty small amount of money. If you have a very large premium, though, it could make a bigger difference. Or if your agent set it up to where, with Guardian at least, it's not unscheduled premiums, it's all scheduled paid up additions. They will break up those scheduled paid up additions and give you that credit right at the beginning. So if you can't put all of the money in at the beginning, spread it, and it has to be spread out. You want to get it spread out with just the base. And then when you do end up putting the money into it, you'll earn the dividend from that point on. Now with IULs, it's a little bit different. You have the underlying cost of insurance that is going to be in there, and that is what's going to be broken up as far as each month. IULs, it looks to me, with how they do the policy charges, they always assume monthly payments are going to be there because they charge you a monthly fee just to keep the policy going, and it's something like $12 a month. It's not very much. It's like $70 a year. It depends on the company, but I think they already have that built into it. And you have the flexibility with the IUL of putting in as much or as little as you want each year. As long as your cash value is enough to cover the cost of the insurance for the year, they don't really care when you put it in. And I attribute that to them basically charging you for monthly deposits regardless of whether you actually do it monthly or not. So the biggest difference as far as putting it in monthly or yearly on the IUL is going to be the index segments that you end up with. The sooner you get the money in, the sooner you're in the index, the sooner you can get growth on that policy. So case in point, my policies, I had one of my policies, I had 3 different times over the year that I put in premiums in the first year. So I ended up with 3 different segments. The stock market performed differently on 1 out of those 3 segments. So the other 2 were the same. I ended up hitting the max on the 2, and then right in the middle of the pandemic was when my 3rd one came up and it dropped. I thought I was not going to earn anything, but the market came back just a little bit right before my segmenting period. I ended up getting 2%. So I got 11% on the first 2, and then I got 2% on my last segment. So that can make a difference. Timing can make a difference when it comes to what you end up being credited. Now, that doesn't mean it's necessarily good or bad to have it all in one or broken up into multiple ones. A lot of these companies offer the ability to have, it's very similar to dollar cost averaging, but they'll basically split it up into 12 segments for you so you get one each month. And that's basically spreading out your risk of any one point hitting in a downtime and the rest of them being up. So I haven't done the numbers on this yet, and I'm planning to crunch the numbers to see which one is better and put a video up on that, but I haven't done it yet. But the idea is if you put all of it in for one segment, that segment could be up or down when it rolls around the next year. If you split it up, now you have 12 segments that each one could be up or down, so that you have a higher likelihood of getting some growth every single year rather than just a growth or no growth in any particular year. So that's the idea. Up to you how you end up ultimately wanting to fund it and try it out. And when I do get that video made, you can be sure I'm going to share it with you all. Okay. Oh, you'll do it. Oh, it's super comfy, high quality material, stretchy, supple, and the inside is fleece lined or something like fleece. Nice, nice. All right. Well, it was a pretty expensive sweatshirt, so I'm glad to see that it was that it's doing good for you. Hey, we got a donation. Thanks. Appreciate that. Appreciate the tip. Okay, so let's go to the next question. I think I answered question number 2. If for some reason I didn't quite get it all, let me know. But let's move on. Question number 3.
Hi, James. I was just wondering, what are a couple of the top whole life and IUL companies that you work with and would recommend? Thanks.
Awesome. All right. Good question. So I already talked a little bit about the IUL companies. My top 2 are National Life and Allianz. And the reasons for that is National Life has a really good cost of insurance. You just end up getting more insurance per dollar than most of the other companies. They offer a flexibility that I can design the policies for very, very low contribution amounts. So it works awesome for kids. It works great for anybody who is just getting started. And if you only want to put in $100 a month or $200 a month, we can dial that insurance down quite a bit, and you still get the same performance that any other rate does with a National Life policy. Other companies, some of them have a $250,000 minimum in order to qualify for their best health rating. Some of them have a $100,000 minimum that your face amount has to be. This is your death benefit, that your face amount has to be in order to get the top health rating option. If you go below that, they either won't let you get a policy or they won't let you have the best health rating. That can make a difference. If you normally would qualify for the top health rating, but they're just going to give you a standard health rating, that can make, over the course of 20 or 30 years, that might make a difference of like $150,000 from what I've seen. It can be pretty substantial. So I like that flexibility in being able to offer as low as a $25,000 face death benefit, and then I can add in that cheaper term insurance. I can add in up to $75,000 more. So we could have $100,000 total with the special design that we do, with the way that we design the policies, so that it minimizes the agent's commission, maximizes your cash value. Now with IULs, what that means is that face amount is what the commission is based off of. It's all based on term insurance, but the face amount is commissionable term, and the rest of it is not commissionable term. It means we don't get a commission for adding in that extra death benefit for you. You pay less because of that, and your cash value grows quicker because of that. So that's the key to those IUL designs. With the National Life, I can do that at the bare minimum. And of course, they always, on all of their policies, throw in 4 living benefit riders, which are like pseudo long-term care policies. where they will cover you for terminal illness, illness, chronic injury, and critical injury. That's a really, really good suite of riders that they throw in on every policy, and it allows you to access not just your cash value, but your full, up to your full death benefit prior to you actually passing away. That is a great thing for allowing you or your family or your loved ones to do their best to actually have money that's available to try and save your life or to try and make it most comfortable if you have a very short time left to live. They're not going to end up going bankrupt or be way behind on bills because they were unable to afford the hospital bills and the medication that you were requiring to try and stay alive and to try and stay comfortable and out of pain, only to then get a death benefit after you pass away and then have to try and rebuild everything. So that's the advantage of the living benefits. Most IULs only come with 1 or 2 living benefits. And if you want to know more about that, I can get into it later. But that's essentially why National Life, why I'm such a big fan. Allianz now, the second one. Allianz has the greatest growth potential that I've seen, along with the best guarantees and the lowest charges that come along with that. You end up with so IULs in general, when it comes to trying to maximize your cash flow, the risk gets shifted from the insurance company onto you, the client. Now that comes with when they add in extra bonuses or when they offer extra bonuses, they now offer asset charges that go along with that. Some companies will charge you just to access the index. There's a big company, they sell a ton of IULs, and I don't know why. I think it's just because they have a lot of salespeople that end up talking to a lot of people. It is not the best product out there, but they sell the most of it. And they charge you 2% just to participate in the index. Now they say they give you a guarantee of like 1.75% floor instead of a 0% floor, but then they charge you 2% just to participate in their basic index options. So it's kind of a bait and switch in my opinion. I don't like it. It's really not that great of a product. Other companies will charge you higher asset fees along with the bonus options that they'll put out there. Allianz, it's a 1% asset fee for their best bonus option, which is a 40% bonus option on top of any growths. And then they also offer a couple of uncapped index options, which if you're willing to put in a little extra time managing them, you also have the ability to lock in the rate. You can lock in the growth rate on those 2 options at any point throughout the year. So with that flexibility, if you're willing to put in a little bit of extra time, Allianz earns the top marks for me when it comes to growth potential. So I'm in the process of starting a couple of Allianz policies on my daughters. If you've been watching my videos, you know I've got policies through National Life on my daughters. I did that one first because I wanted to make sure that I've got those living benefit riders and that they're available. Now that I have my whole life insurance set up, I've got the living benefit riders set up. Now I'm looking to expand my growth, and I'm trying to find products where I can take on a little bit more risk and go for the growth. Okay, so there's your IUL. The top 2, I would say, when it comes to whole life, I would say Guardian and Mass Mutual. 644. All right, I'm just talking. Hopefully you guys are getting some good information. Let me know if you think I'm droning on and on. Whole life companies, top 2 for infinite banking, Mass Mutual and Guardian. They're 2 of the 4 major mutuals, which if you've been on YouTube, you've probably heard of the 4 major mutuals. Steve Parisi talks about them all the time, and his videos are awesome. IBC Global, if you're not familiar, if you haven't seen those videos, check them out. Me and Steve are business partners, not total business partners, but we work together. He's the one that got me into this, showed me how to design those policies, and I kind of ran with it. So I work with IBC Global, basically, when it comes to Mass Mutual and Guardian. I don't go through them for any of the other products that I offer, and I'm contracted with a whole bunch of different companies. so that we can figure out what's going to be best for your situation. But Mass Mutual and Guardian, two of the four major mutuals, we can design a 90-10 split, which gives you awesome cash value in year one. Guardian takes the top marks, and if you've seen my videos on Guardian, you'll know why. If you haven't seen it, check them out. I'll try. I don't know if I can put card links in here after the live stream, but if we can, check it out because I will put them in. I'll put a card link up there for them. But otherwise, check out my videos. Guardian has the best flexibility in all the whole life companies that I'm familiar with. Okay, we can design them 90-10 split. We can do monthly payments with just the base premium, and we can have unscheduled premium payments for the whole rest of it. So if I do a $20,000 a year policy design, I would set that up with a $2,000 base premium that comes out either annually or monthly for you, meaning like $200 or less a month. And then everything you put in above that throughout the year, you can dump in that extra $18,000 at any point throughout the year. And that's a flexibility that basically none of the other companies offer, in my experience. So when it comes to choosing what policy is going to work best for you, it's not just the dividend rate, and Mass Mutual and Guardian are the tops when it comes to dividend rate. Average, they're the tops average when it comes to dividend rate. Oh, I can pin my link in the comments. I'll have to check that out when I get a chance. Over the last 10 years or 25 years, Guardian and Mass Mutual are the tops when it comes to dividend rates. So whether one is above the other, I think they flip-flop a couple times. Mass Mutual ends up beating out Guardian, and I think every other company when it comes to the average for dividend rates over the last 25 years. And they've both been paying dividends for, 150 plus years. So I don't look at dividends as the number one choice. I go to flexibility because you have to have the flexibility to meet your needs when it comes to contributing to these policies. That's going to be the number one choice. It doesn't matter how great the company is if you can't get your money into it in a way that you need to. So, not droning on, feel like you make it simple to understand. Oh, good. These things are complicated to grasp. It's easy to get drawn into returns, but flexibility is good too. Yeah, flexibility is the number one thing. Like I said, if you can't get your money into it, what good is it going to do you? It doesn't matter how good the policy is. So Guardian is the number one for flexibility. Mass Mutual has some better, well, okay, one more thing with Guardian. You can do electronic funds transfers and you can get your money in really quick. I just put up a video this morning that shows you how to do a loan request, and I walked through all the steps and what the documents ask for and what they mean. It's not very complicated, but there's some things in there that maybe you just aren't sure what they mean, or maybe when you end up wanting to get a loan, you want to be able to skip over them. You can at least go through, and I'll tell you what it means before you get to that paperwork. But that loan took me 3 days. So I put in the request. It was in my account 3 days later. That's awesome. I think the time before that, I got it in 2 days. So it just depends. But 2 or 3 days is about the time frame that it takes for me to get money out of the policy. And to put money into the policy, it's been about 2 days. With Mass Mutual, the downside to them is they still mail you a check. They're not doing electronic funds transfers. They're not putting it directly into your policy, and they're not pulling it out. Genscher, what about top companies for IUL? I just went over that. So when you get a chance, replay this, and it'll be right about the probably between the 35 and 40 minute mark when I started talking about IULs. But I think I went into that pretty extensively. If you find that you still have any questions, come back next week and we'll answer them for sure. So Mass Mutual still mails checks. So when I get a loan out from Mass Mutual, both times that I've done it, it's taken about 10 days to get the loan. So less flexibility when it comes to accessing your cash. Flexibility to stop paying. Yes, they do. I mean, basically all. I'll interrupt that other question answer. So Top Gun says, could you answer my question about IULs for my kids? Does Allianz have flexibility to stop paying? All the IUL companies basically offer the option to stop paying at some point. You really don't have to make payments at all. You just have to have enough in the policy that it will continue to be able to make the premium payments that are due. And the premium payments that are due is the annual renewable term each year. The difference between your cash value and your death benefit is the amount of insurance that you have to pay for each year. I don't know of any IUL companies that actually stop requiring those premiums if your policy is in force and you haven't triggered your overloan protection rider. So the ability to stop the policy requires triggering that overloan protection rider. The overloan protection rider is available after age 75 typically, or 15 years that you've owned the policy. And what that does is it turns off the premiums. You pull out as much cash value as they will let you pull out as in a loan. You don't withdraw it. You pull it out in a loan, and then you trigger the overloan protection rider. The insurance company guarantees you that they will maintain a minimum death benefit and your policy will not lapse. So the idea behind that is you will not end up with tax consequences from a policy lapsing, and suddenly now you owe a bunch of taxes on gains that you had in the policy. So that is possible, but after age 75. Now, insurance costs, the term insurance on all of these is pretty cheap until you get up to about that age. So there isn't really a reason to turn off the ability to put money in prior to that, in my opinion. I also view these policies as retirement type vehicles. So my suggestion is plan on paying it until you want to retire and start pulling money out of it. That's the best way to utilize those policies and ensure that you're going to have awesome cash growth. So hopefully that answers that question. Back to Mass Mutual. Mass Mutual, so while they are a little bit slower to get money out, maybe that's not the flexibility that you need the most in your policies. Mass Mutual does offer the highest dividend rate. They also offer the ability for me to do a 1090 design that can extend out as long as you want to pay that in the policy. So I can do a 1090 design that lasts 40 years or 60 years. With Guardian, I'm limited to about 15 to 20 years. It's usually about 15 or 16 years, but I have seen a couple where I'm able to do enough insurance, where I'm able to blend enough term insurance that I can make it last 19 or 20 years. But the structure of the policy with Guardian, every time you buy paid up additions, it burns off. It replaces some of that term insurance. And as soon as that term insurance is all gone, you no longer can contribute 10 times the amount. That's the limitation with Guardian. With the flexibility that it provides, most of the people that I talk to and that get into the Guardian policy, they know that they're planning on making either basically from 7 to a 15-year premium payments. And then after that, they'll concentrate on other things or they'll start other policies. With Mass Mutual, you don't necessarily have to do that. We can make it so that you can just keep going and going and going with that 1090 design. So Mass Mutual is great when it comes to being able to just keep those payments going for long periods and get that early cash growth. There's other companies out there that offer good long-term growth, and you can have a nice split, like a 60-40, 70-30, 80-20 split, but they're limited. They don't give you that early cash growth and the break-even, the early break-even years of like 4 to 5 years. So those are my top two, Mass Mutual, Guardian. I do have a third one in there that's coming up strong, and that's Penn Mutual. I know there's a lot of companies out there, or a lot of agents out there that like Penn Mutual as their number one. They have a really strong illustration. Their dividend rate is really good still. It's 6.1% this year, which is only second to Mass Mutual. There might be some smaller ones out there that might have a higher rating, but we tend to just look at the top-rated companies. And they're also a top-rated company. So they've been around for over 150 years as well. So Penn Mutual, been around a long time. They're a little bit smaller. They're not one of the four major mutuals just because of their size, but it's a good company. They've got a track record of paying dividends, of paying high dividends. Over the last 20 years, it's been really strong, and we expect that to continue. They don't have the flexibility that Guardian offers. They're they basically have the same, what do we want to call it, the same strict guidelines around premium contributions that Mass Mutual has. And in fact, I think Mass Mutual's might be slightly more lenient. So that's a downside that Penn Mutual has. But they can project out good cash growth. If you don't need the cash value early in those first couple of years, if you can get away with an 80-20 design, I can design an 80-20 design with Penn Mutual. It can look really good with a 70-30 and a 60-40. Those can all be good long-term growth-wise, but the early cash value isn't so hot. So that's a trade-off you get. So that's why that one doesn't make my top two. But they're in the top three because of that strong growth, the history of dividends, and also they're currently approving policies in as little as 2 days, start to finish, which is just amazing because most of the companies I work with, you're looking at 3 or 4 weeks, maybe 2 weeks. National Life, I've had about 2 weeks them do it, but for the most part, we usually see 3 to 4, maybe even 6 to 8 weeks on some types of policies. Penn Mutual, as little as 2 days on some of the more recent ones that they've done, that's amazing in my mind. So if for some reason you like that, if you need to get something passed very quickly, I don't know why you would need it passed that quickly. Maybe you just want it passed that quickly. Penn Mutual might be a good choice to go with. And we can definitely get you illustrations on any of these companies. So let's see. How are we doing on time? 6:57. Since my family's not here, I'm going to go more than an hour. I want to try and get to a couple more questions, and hopefully you guys will stick around and find good value as we continue. So let me see if there was any questions in the chat that I missed before I go to the next voicemail. What would be the lowest, smallest policy that overfunding would actually make sense? Funding wise, like a starter policy where it's worth your time and you make some money as well. Okay, so I wouldn't worry about my time. What makes it worth my time? I don't worry about that. I design policies, like the smallest policies I design tend to be for kids. And we do it at like $100 to $200 a month, how we set it up to do. And as far as a commission that pays me, I might make a $200 commission because of how we design it. Now, I could easily design it knowing that you're probably not going to access that cash value early for the kids. You're probably not even going to really care that much if 60 years down the road, the cash value difference might be $80,000 difference between a perfectly designed one and one that pays me a lot more commission, because the policy you're talking at 60 years down the road might be worth $2 million. So 80 grand ain't going to make that big of a difference. I don't look at that. I don't really, you just won't see me design a policy that's going to end up paying me more just because I think my time's worth more. Okay. So I would rather just design it the best for you, and I just do that every single time, and I don't worry about it. The money's going to come in. I will keep selling the policies as long as it's enough to keep the wife happy, and we're good to go. So don't worry about what it means to me. With other agents, it might make a difference. So something to consider. If you have an agent that you really like, and they demand to make more, maybe you're okay doing that, and that's totally fine. I mean, when it comes to small policies that kids do, it's not that much of a difference anyways. I mean, you're talking probably the difference between $200 and $400 or $200 and $600 that the agent brings in. So to me, I don't care which side of that I'm on, as long as the policy is designed good for you guys. It does make a difference down the road, and the way I view it, if we start off with this policy, you're going to expand it later anyways, and that bigger policy, we'll still design it the same way, and you're going to be happy. I'm going to get paid again, and we'll be able to keep the relationship going, and everybody's going to be happy. If you come back later for another policy and I show you a different design that works better, you might be going, well, why didn't you design it that way the last time that we did it? Like, now I'm wondering, whose interest are you looking out for most? Now, if you're upfront about it, if the agent is upfront about it and just says, look, here's the deal. If I can design the policy this way, and it'll pay me $100, and it's going to give you this growth out here. But if I design it this way, you're going to have a little bit less out there, but I actually make enough to compensate myself. If they're upfront about it like that, and you're totally fine with that because you built a relationship and you want to see them, I mean, that's the way I tend to be. If I'm working with somebody like a car salesman, I don't go in there and just beat them up on price and try and get them as low as possible. I used to sell cars a long time ago. I know it's tough. They can make a whole lot of money, but that wasn't what I tried to do. And if it's a really skinny deal, if the dealership's not making much, the salesman isn't going to make hardly anything. I don't mind going in and just paying, if the dealer makes a $500 or $1,000 profit on a car, I'm okay with that, So same situation here with the life insurance. If you're okay with the agent and they're upfront about what they make, and you don't mind having a different design because really 60 years down the road, you're not going to care all that much, awesome, go for it. And the way you know that, the way you can check on how much they're making, it's called target premium. So when you look at the illustrations, it will tell you minimum premium, guideline annual premium, which is your MEC limit, and it'll tell you target premium. There's a couple other things that are in there, but those are the three that are important. Target premium is what the agent's commission is based off of. So, all right, let's see, where are we at now? So the smallest amount that we can design it to perform well like that is probably about like $100 a month. That would probably be something that we can make look good. I know I did that for my daughters. I think the maximum that I was able to put in, even with that design, ended up being a couple $100 a month. But my plan was I wanted to at least be able to put in $100 a month. So we can tighten it up as much as you like when we put these things together. So Top Gun says, that's what I thought. At what point does cash value exceed the term payment? If I paid 15 years worth on your kids and left it to them to take over at 18, does that keep it going? Oh, I see what you're saying. How much? So Top Gun, you're asking me how much growth in the policy before you can stop putting it in and it's going to continue to fund itself. I would think 15 years on a kid. Yeah, you're probably safe there. Really what it boils down to is the yearly cost for the insurance on your kids. If it's likely going to be a pretty small amount, so it'll probably cost like $100 a year to cover their cost of insurance. So if you get $5,000 into your policy, you may be making enough to overcome that amount. Probably though, well, I'd probably say actually 10,000. Probably need about 10,000 in there before you're going to overcome it. So if you're putting in $1,200 a year, 10 years should be fine. Now we tend to see if the index is going to be performing, you will pass a break even at around year 4 or 5 in these policies. If it's performing really well, you could pass your break even in year 2 or 3. I know on my policy I gained 11% the first year, and I almost broke even already. Who knows where we'll be at next year? Hopefully we'll hit it again the same time. Hopefully we'll get to max that out, but we'll see. Okay, so let's see. Can you explain why a 70-30 can beat a 90-10? You're doing real estate and really value the ability to leverage your cash. Okay, this one might take a little bit of time. And it's pretty contentious. You've got a lot of people out there that are pushing the 70-30 design as if it's going to be better for you long term. Even though it gives up a lot in the short term. You end up with basically 70% cash value rather than close to 90%. I mean, that's essentially what it turns into. The 90-10 is 90% goes to PUAs. 90% of your premium payment goes to PUAs. 10% goes to base premium. And essentially, that turns into cash value. Everything that buys PUAs goes to cash value. So it doesn't work exactly one-to-one like that, but it's close. So why would a 70-30 beat a 90-10? If it comes to policy design right now, the greater the cash value, when it comes to illustrations, the greater the cash value you have in year one, the greater the cash value it's going to be long term. So a 90-10 will almost always, in my experience, especially if you go company to company and you're not trying to compare different companies, but if you go company to company, the early cash value is going to beat long term a design that has a lower early cash value. So a 90-10 with Guardian is going to beat long term in death benefit and cash value a 70-30 design. With Mass Mutual, same thing. With Penn Mutual, a lot of these guys talk about a 60-40 split. When I do the illustrations on there, I can get an 80-20 split. So you don't have to get a 60-40 split. And the 80-20 split gets you, I think I can get you to about a 5-year break even, depending on your health rating, which is really good. And you end up with about 80% cash value. So I can make a really strong first year for Penn Mutual. Why would I want to design one at 60-40? I don't want to be too cynical here, but at 60-40, it pays me a hell of a lot more commission. Okay? Penn Mutual alone pays higher commission than any of the other companies, than any of those other companies that we've talked about. And it's not just because of the design. It's not just because I can only do at best 80-20. They pay a higher base overall, which is great. It's great for the agent. And long term, the illustrations show that it can perform well, even better than some of those other companies long term. A lot of that's because of the current dividend rate. Okay, all of the illustrations from whole life, they project out from the current dividend rate. So Northwestern Mutual, really low current dividend rate. It's like 5%. So when you compare an illustration for them long term against Mass Mutual, who has a 6.2%, it doesn't perform very well. Now, a lot of those agents don't design policies to perform like we do either, so it's never going to perform as well just based on the designs that I see come out of Northwestern Mutual. But if they were able to design it the same way, you would still see lower values just because that dividend rate is so much lower. Now, when it comes to when can an actual 70-30 design beat a 90-10, that would be when the dividend rates change. So what happens is if you do a design that is, well, there's something special that happens inside Penn Mutual policies. Not special in a good way. But when the dividend rates drop, you have the potential to have it become a mech, because Penn Mutual will not allow you to put more money into the policy to make up for the lack of paid up dividends that was projected based on the dividend rate when you started the policy. So what happens is some people start their policy, they'll max fund it, so they have no more room to put in there, and then the dividend rate drops. That dividend doesn't pay for the expected paid up additions, which when combined with the term insurance gets you to the death benefit and keeps you within this corridor of insurance. That policy needs to see that extra paid up additions that the dividends buy in order to keep the growth above the value of the policy. So what happens is you don't get that growth in death benefit. You don't get that growth in death benefit, which means your cash value has to be lower. Otherwise, your policy will mech. It doesn't mean that your policy is going to mech. What happens is Penn Mutual will contact you and say, hey, you're going to get a mech if you don't withdraw some money out of your policy. So worst case scenario in that, the dividend rate drops, you got to pull a little bit of your money out of the policy It hurts the long-term growth, but no big deal. You're limited to what you're limited. You're still going to want to put in as much money as possible each year into the policy. Now, on the flip side, dividend rates go up. If dividend rates go up, most insurance companies tend to credit more of that dividend to the base premium than they do to the paid up additions that are within the policy. And any amount that you're paying in term insurance is going to be credited less because of the increase in dividend rate. So what we've been in for the last 20 years is reducing dividend rates. Dividend rates have been slowly coming down. That has to do with the overall interest rate environment that we live in and that we don't anticipate much change in the near future. Who knows what it's going to do in the long-term future? These policies are designed to live out, for 20, 30, 40, 50 years, sometimes more. Who knows what it's going to do in the future? It's possible if you're still paying premiums in the future there, when the dividend rates start to go back up, that you could see a greater growth in a policy that you've been paying a higher base premium towards. So that would be long way to get to that answer, but that would be how you would get more cash value in a 70-30 than a 90-10. But we're talking long term. Anything short term is not going to happen. If you are planning on just funding this for 7 years or 10 years, turning it into a reduced paid up policy and cutting out the drag of any new premiums, it's not going to benefit you to have a 70-30 design. You're much better off doing the 90-10. If you're in real estate, that early cash value can mean way more to you than potential long-term growth if dividend rates go up. So one of the things that I consider, and actually this is coming up in one of the other viewer voicemail questions, which at this point I'm going to have to hold those off till next week because we're definitely getting late, but I'm having fun answering this question. And I think we might have a few more questions. So I forgot where I was at. When it comes to real estate people, when it comes to investors, and really how we use whole life insurance in general, we need to view it more as a savings asset. We're not getting into this expecting stock market type growth. We call it a savings asset because we expect, a gradual savings rate. It's a good place to get some growth with our money that's normally sitting in a checking or savings account, our emergency fund money, money that's sitting around for capital expenses or waiting to pay other bills. It's a great place to store those funds. What we're planning to do with that cash value, though, is to earn our growth, to earn our interest and our arbitrage outside of the whole life policy. If you are looking for earning your growth inside of a policy, that's where the IUL comes in handy. So how often are we doing these Q&As? Every week. So we call it Wealthcare Wednesdays. Every Wednesday, I'm, at least for the foreseeable future, I have it blocked out. I'm committed to doing a live stream answering your questions every Wednesday from here on out. So we'll keep that going as long as I can. When I end up going on vacation, who knows what we'll be able to do. Maybe I'll be able to get something set up on my phone, but that'll be a challenge. But I don't have any vacations planned because, country's on lockdown and none of the other countries are letting us in. So, okay, so do I find that multipliers on IUL policies are worth it? For example, Pac Life charges 7.5% to earn a multiplier of 2.7%. Okay, that one's a tough one. I think that's way too much. The charges that I see for Pac Lives is way too much. So what is happening here is anytime we start getting into the multipliers, almost anytime, if there's a charge to the multipliers, what's happening is these companies are giving you an opportunity. They're giving you an opportunity for more growth, but it's going to cost you. So now you're stepping away from the safety that the IUL provides. You're stepping away from that safety of a 0% floor, and you're moving into greater risk. Okay? That's going to be a personal question of whether you want to take it or not. I would not get into a policy like that for large amounts of premium, for large amounts of my overall portfolio. Okay. Um, the Allianz product I was talking about earlier, it's a 40% bonus and it costs you 1%. That's strong. So if you get an 8%, if you get an 8% growth in the policy, you're going to get credited 12%, and it's only going to cost you 1%. If the stock market index has a growth of 3%, now you're looking at just over 1%, just under 1.5%. You're going to cover the cost of that rider. Okay, so for me, I'm comfortable getting into that, especially because it offers an uncapped option and the ability to lock it anytime throughout the year. To me, that 1% adds risk, and then those other options reduce the risk. So that's something I'm comfortable with, and I'm comfortable with doing in larger amounts. Okay, now I'm just starting out with my kids' policies, which aren't really going to be that much. I'm going to be putting in $3,000 a year into those policies and shooting for that bonus multiplier. To get charged 7.5% to earn 2.7, yeah, it's intriguing, and for people that are willing to gamble and risk, might be worth it. Okay, but you got to realize that's what it is, because none of us know how the stock market is going to perform on any given year. So how often do you have to get a gain, and how big does that gain have to be to make it worthwhile? I'm not contracted with Pac Life, and so I haven't played around with those. I don't have any experience with their products long term like that, but I hear about it. I hear about the expenses that come along with that, and they concern me. So that's where I'm at on those. If you want to opt in and try that, come back, let us know how it's going. Check in. But to me, it's too much risk. Too much risk for me on my policies. If I'm set on everything else and I've got money that I can burn, I might consider putting it in there. But the Allianz product with the guarantees that come with that, I think I'm going to be pretty happy with that. I would probably opt for that every time over engaging in something more risky. But that's just me, to each their own. You truly appreciate my integrity with poly design. I'm a go-giver, one of the highest compliments I can give. I appreciate that. I really do. Because when I hear that, it's a recognition of what I'm trying to do and how I'm trying to present everything that we deal with. As you know, if you've watched my videos, I don't bag on Iuls because I'm trying to sell whole life. I don't bag on whole life because I'm trying to sell Iuls. I don't bag on the stock market because I'm trying to sell insurance. And I don't bag on insurance because I'm trying to sell the stock market. I try and look at all of this stuff realistically and think about, what would I do with these products? How can I design them the best for you guys? And how can I present the information and share with you guys this stuff in a transparent manner so that you know exactly what you're getting into? You know how much risk you're comfortable with. You know how much you're willing to put in this investment vehicle and this investment vehicle. And if you don't know, I want to talk to you about it so that you do know. I'm trying to empower you with this channel, and not just with insurance, but also maximizing your cash flow, right? I know we end up mostly talking about insurance, but that seems to be what most of my viewers are interested in. But I'm here to talk about how to pay down debts quicker. I'm here to talk about maximizing your cash flow. If I end up finally getting into real estate investing, which I'm trying to do, I just haven't done it yet, you can bet I'll be sharing anything I learn with you on that. Now, there's plenty of channels out there that focus just on that, but I think there's a lot of value in us sharing our experiences in the wins that we make, and it can give ideas to other folks. So that's why you see I don't just do videos around finance. Sometimes, I just take videos sometimes about anything, like do-it-yourself projects, and I'll put those out there. If there's something in there that I think that you might find value in, I'll put it out there. Or if it's just something I want to share because, the family watches the channel too. Like when I did the yard makeover. I'll share that because my family watches those too, and I don't really have another channel that I'm sharing that on out there. So hopefully you guys enjoy all that stuff, and I'm providing you good value. And if I put out a video that's not your cup of tea, if you're only interested in insurance and I'm talking about quads, just ignore it. All right, so let's see. Does Allianz have multipliers? Yes. Allianz has two different bonus options. The one that they offer that's free is a 15% bonus, and the one that they charge a 1% asset fee for is a 40% multiplier. Those are great. They have different caps depending on those, depending on which index option. But then they also have the uncapped options in both of those. And the difference between the uncapped options in both of those is the participation rate. So in one of them, I think the participation rate is 135%, and in the other one, I think it's 150 or 155%. So they always, when it comes to index options, insurance companies will always trade you one thing for another. When they offer you bonus multipliers, they're going to somehow offset that risk on their end. They're going to transfer some of that risk to you. When it comes to participation rates, that risk is overall growth potential. Okay, you're going to limit your overall growth potential with that particular index at 135% or 150%, depending on the multipliers. And the greater risk that they want to offer you, the more they'll end up charging you to give you that. That's where you get the 7.5% charge, or the 1% charge, or the 2% charge. This depends on the company. But essentially, it's up to you to decide how much risk are you comfortable with, and how much risk are they trying to transfer to me, and do I want it or not? Those are the ultimate answers. So you hear Allianz has some of the best multipliers. Yeah, they are. I really like it. And it's not just that they're some of the best because of the numbers that they are, but they also, it's with the guarantees that come along with them that help to make them the best. The 15% guarantee that they have for the free option is really high. That's strong. That they offer all of these along with a fixed 5% loan option where you can still keep your money in the market and potentially earn 8, 10, 12, 14 plus % interest. That's amazing. You know, it's very attractive for someone like me. So how often, oh yeah, we already answered that one. Appreciate your answers on the whole life 70-30. You were torn on your policy design. You have a ton of input for you in formulating this for real estate investors. This is a tool for a disciplined need. I'm assuming that last word was going to be need. Yeah. Oh, there you go. You finished it. Disciplined. Oh, nerds. Disciplined nerds out there. It's a tool for the disciplined nerd. Yeah, that's right. When it comes to the real estate investors, like I was saying, and I don't think I fully expressed it, but like 20,000, the difference between if you have $100,000 that you put into the policy, and you have a policy that gives you access to 90% of that, so 90,000 in the first year, and a policy that gives you access to 60,000 in the first year. That $30,000, that could be the difference between you having enough to invest in a real estate deal that you could earn 30% on. So when it comes to having that cash value available in year one, to me, if you're using it for outside investments like that have the growth ability, like maybe you took that 30,000 and you did a flip and you might have made 200% on that 30,000. It's almost limitless. If you own a business, that 30,000 can do a lot more for you if you need to pull it out and buy an extra truck, or you need to pull it out and buy more equipment. It can make more of a difference in your hands by you having the ability to access it than it will a few extra percent or a very tiny percent growth 40 years down the road because you had a 90-10 design instead of a 70-30 design and the dividend rate went up. But if the dividend rate didn't go up, you missed out on both of those options. You have a lower cash growth at the end, and you missed out on the early cash accessibility. So there's always trade-offs around there. It's just what's going to best serve your needs. So If you max fund, Joy says, if you max fund an IUL, what should you expect your net internal rate of return to be? Oh, that was one of these questions. Hang on a second. I want to play that one. Question number 6. Here we go.
Hi, James. It's Joy again. My second question is, if you max fund an IUL over the life of the policy, what should you expect your internal or your net internal rate of return to be? Thank you.
All right. Thanks, Joy. Okay, so good question. And I'm sure this is something a lot of people look at. Internal rate of return on the policy 30, 40 years down the road. What should you expect? The answer is quite a bit more complicated. I don't really know what your expectations should be. The actual rate of return is going to vary incredibly wildly depending on your index options, the bonus options, how much you actually contribute to the policy based on your cost, how old you are when you start the policy, because your insurance costs are going to be lower in the early years and higher in the later years. So if you start the policy, in your 60s or 70s, which some people do, I wouldn't recommend necessarily an IUL in that case, but depends on the overall situation and your goals. Some of those can work. I know there's some premium financing options out there that they say can work for a 60-year-old with an IUL. But the underlying cost of insurance relative to how much you're going to put into the policy is going to affect your internal rate of return. So how much you can actually expect, gosh, I really don't have any idea. But I thought it was a great question because there's a lot of things that go into that and a lot of things that you should consider. So it's not just what is the best numbers that this agent can put in front of me with their illustration. That is not how you should be shopping for an IUL. You want to make sure that the guarantees that come along with it and the risks are balanced to meet your personality, okay? That they're balanced to meet your ultimate needs. You don't want to take too much risk and end up with too much money off the table in the end, and now your needs aren't met because you tried to get a little bit too much. You reached a little bit too far and you took on a little bit too much risk. Because some of these policies will do really well if we set them up at the base, or you just take the free bonus option, or you go with a capped option instead of an uncapped option. All of those decisions can make such a big difference in your ultimate return each year. And then, of course, the overall return, long-term net internal rate of return. So hopefully that gives you an idea on, hopefully that answers your question to some satisfaction. When it comes to illustrations, I've seen anywhere from 6% to 10% in long-term internal rate of returns. So, and I can illustrate both of those on the same exact policy just by tweaking a few things. So a lot of it comes down to the integrity of the agent that you're working with. And if I'm showing you an internal rate of return that's at 10%, you can be darn sure I'm going to also tell you that may not be likely. It's a possibility. Based on how we designed it and the index options we put into it and the funding that we expected you to put into it and the charges that the insurance company is currently charging for insurance, that's a possibility. It's definitely not a guarantee. So as long as we're on the same page with that, then I think everything's good, and I'm okay with at least showing it to you. I typically try not to even show the most that I can do, though, in that situation. But you know, if I'm competing with another agent who's showing you the absolute best that their product can offer, it doesn't really suit your needs or my needs by presenting you a product that can illustrate better, but I'm limiting it on my side to something that I think is just realistic, because we don't know how the stock market's going to perform. We don't know how the index options are going to perform in the future. We just simply don't know. But we're going to look at the history going back, and we're going to make our best guesses, and we're going to roll the dice a little bit. That's the idea behind the IULs, and you just got to ultimately decide what you're comfortable with. So let's see, Top Gun. Yes, that's my point with the 70-30 design. 30 grand gets a lot of work done in the real estate world. Yeah. You think it's also a reflection of your activity level in investing? Yeah, that too. So certainly 30 grand for an active investor, somebody who's I mean, you could put 30 grand in and out every couple of months. That can make a huge difference as opposed to somebody who might just use it once throughout the year. And then plus if you made money on the 30 grand, you could just use that to buy more insurance. Yeah, you really can. You guys got any more questions for me? I know we're kind of running a bit long, and I think hour and a half. I think we're doing pretty good. I'll save the questions. I've got 2 questions we didn't get to. I'll save those for next time. And we'll get to those beginning of next Wednesday. So unless something comes up, I want to thank you guys for joining me today. Hope you found a lot of value. I don't know if you can see this, but I love getting into this stuff. I know after the first live stream, even my 16-year-old kid, who really doesn't care a whole lot about what goes on or what goes on my channel, he walked by and he says to my wife, he said, "Dad looks like he's really enjoying himself." So yeah, I did. I enjoyed myself then. I'm enjoying myself now. Hopefully you guys enjoyed participating in this. And if you're watching this after it's done, hope you enjoyed watching it and you'll join us next Wednesday. Remember, if you want to leave a voicemail message, go to my website, OregonCashflowPro.com. You can record a message there. I'll play it on here. You can join us and put your question in the chat. I will try to balance those. Oh, we didn't get to the prize. Let's figure out how we're going to do a prize. Hopefully you guys all didn't leave yet as I was trying to wrap this up. I want to give something away. So whoever's still on the chat, looks like there's still 12 people up here. Pick a number between 1 and 10. Pick a number between 1 and 10. Put it in the chat. I'm going to give you guys about 10, maybe 15 seconds to put your numbers in the chat, and then we will do a random number generator. So pick a number between 1 and 10. All right, we got a couple numbers coming in. All right, I look forward to seeing you next Wednesday too. All right, we got a few numbers. I'll give it a few more seconds here, see what we come up with. If you put a number in there too, let me know what you want to win, because we haven't decided on a prize yet either. I know a lot of you guys already have the books that I find valuable and I'm putting up as prizes. So let me know. I'm willing to do another hoodie if that's what you guys would like. It sounded like it was pretty nice. Yeah, group chat in the future would be good. If not everybody uses Facebook, but it's really easy to set that up with Facebook. Might be able to set up something maybe with Discord, or we can set something up in my Patreon. Actually, Patreon might be the best place to do that. I think I can set up a chat in there that doesn't necessarily require anybody to be donating to it. I've stopped sharing that link because nobody was really participating in it, and yeah, Top Gun really likes his sweatshirt, it looks like. Okay, random number generator. Clock is ticking down. I am going to go 1 through 10, and we're going to do it in 10 seconds. Oh, it's buffering? Hopefully my stream is working. I know I've had some notifications that some frame rates got skipped, but hopefully it's been working well enough. All right, here comes the number generator. Oh, good. You just made it in, Silas. All right, our winner is 2. There we go. Number 2. Who had number 2? I think we saw number 2. Poker. Poker's the winner. You had some good luck, Poker. I will do it sooner. In fact, next week we'll do a couple of them. You know what? I will do another one. You guys all had a lot of numbers in there. Let's do one more. Because Poker won something last time, too. So I'm going to do another one. Yeah, Jones, we'll do another one. Pick a number. I'll go 20 more seconds because there's a slight delay. So 20 more seconds. Don't change any of your numbers from earlier. You can't change your numbers. Except for Andrew, because you picked 11. I'll let you change it if you want to come in. Otherwise, I'll mark you down as a 1. And we have a couple other ones. All right, yeah, Gretchen, you're still 7. Cool, cool. Jones, are you gonna... Did I ever get you your last one, Jones? I don't even know. I know there's a couple people from that first live stream that still have not claimed their prize. I've got to go back and look and see who that is. All right, Andrew, good. You got a 4. Benjamin got in there. Yeah, it's okay to pick duplicate numbers. So in the case of a duplicate number, I'll count how many people did that same number, and then I'll do a random number generator among that. So if 3 people did a number 1, I'll do a random number generator between 1 and 3, and then whoever guessed in that order. So if a 3 pops up, the third one who guessed a 1, they'll be the winner. So, all right. Still 9. All right. We're good. We're going to do it again. Here goes the random number generator. I'll do it. Let me zoom in here. We'll hit the button. Number 10. Number 10 is our winner. Who's number 10? A1 Iron. A1 Iron is our winner. So, A1 Iron, if you email me, yeah, you're right. It definitely lowers your odds if you pick a number that somebody else did. All right, good. You're here. So, winners, Poker, I know how to get in touch with you. A1 Iron, if you email me, you can contact me through James. Just email James at OregonCashflowPro.com, or you can go to my website, OregonCashflowPro.com, and just send me a message through that, and then I'll contact you. But I'll send you a link if you want something from the Teespring store. T-shirt, shirts, they got leggings, coffee mugs, phone cases, bags. So you got all kinds of choices there. So if you want something from that, just let me know. Or if you want a book, let me know. And I'll send you a link for where to get it. And the way it works is you buy it, send me the receipt, and then I'll connect you. I'll pay you through PayPal, or if it has to be a different service, I'll transfer money that way. But PayPal is my number one choice. It's the easiest one. I can get it right out of my business account, since we're writing these off as an advertising expense. So, all right. So congratulations, you guys. It's been fun. We'll see you guys next week. And be sure to keep checking out our videos. If you got any questions, you know where to leave them. Come back here, ask them. I will help you out the best that I can. Oh, that's funny. You can hear me typing. Oh yeah, my sound is still on.